Welcome to Cambridge House Live. I'm Bridget Anderson, and I have with me today Peter Spina, who is the CEO of goldseek.com and silverseek.com. Thanks for being here.
Thank you for having me.
Let's start off with your macro view of what you think is going on in the markets.
Okay. Right now, the gold markets are in a consolidation phase. We had a really great run a couple of years ago. Gold ran about $1,000 an ounce, peaking around $1,900 an ounce. We're near those record highs right now, and over the last year and a half, especially over the last year, we've been in this consolidation kind of sideways phase. From a larger, kind of longer term perspective, the gold market is in this kind of consolidation phase. We're building a really strong base. The market is very healthy at these levels. We see a really strong demand coming in from the fiscal buyers, especially central banks. China's been a big buyer, importing incredible amount of gold through Hong Kong. We've seen 50 to 100 tons a month being imported there. So we're seeing some really strong investment demand and the return of gold back to money. So these drivers are really putting into place the next leg higher for gold, which I believe will take place probably more likely second half of this year, maybe into even next year.
Is there a trading range that you're looking at?
Yeah, right now the key levels, we're trading just below 1,700. That's a key level. We'll bring some more momentum into the market, but 1,800 is a really key level, then 1,900, 1,925. A break beyond that sets off 2,000 plus gold very quickly. And I believe, just like the last big run, once we break past those levels, the gold market will move to a new higher.
So you think that's attainable?
Yes. I think the fundamentals in the market continue to improve. My primary reason for investing in gold for the last 10, 15 years has been investing into gold as money. Gold is money. It is returning to its historical standard as money, as the US dollar continues to be debased by the vast amount of money printing. The European Central Bank is printing money. The Japanese Central Bank is going to start embarking on a very aggressive money printing program again. So as the global currencies continue to debase, the money of trust will return, and that is gold.
So what do you see happening then in the U.S. economy?
Well, the U.S. economy is being supported by this artificial structure called the Federal Reserve, which is printing about $85 billion a month, subsidizing these low interest rates. So we have a bit of a recovery, quote unquote. The housing market is starting to see a bit of a lift, and we might see a pretty decent economy this year in the U.S. holding up for part of the year. But the fundamentals behind the economy itself has a lot of issues, and it's being patched over by printing, and we can't continue to do this without seeing some sort of consequences. So at some point, all this money printing starts translating into inflation, and I think that might be kind of the problem that they're going to start facing is what will happen with the bond market if inflation starts taking off and they're unable to control these low interest rates. What really keeps this game going is the fact that we do have low interest rates. A 1% move in the interest rate financing costs.
That could be a big game changer.
Huge game changer. $165 billion a year. If we had 2, 3, 4% increase in the interest rate borrowing costs, the game would be over. So I think their plan is trying to kickstart the economy, but there's structural fundamental issues which have been caused by their manipulation into the free market system. Over the last decades, they have come in whenever the market's ready, the economy's ready to do a contraction. The savers, the borrowers, they're not willing to extend credit. And so there's a contraction, which is a very healthy, natural process, but the central bank comes in, the lender of last resort comes in and says, we do not want a contraction, we want growth. So we have a vast misallocation of capital, and we really don't know what the equilibrium is. So, it's really troublesome to see that with $1 trillion a year that they're printing, that they can't kickstart this economy and really get it growing. If we're barely growing at these levels, what happens when they pull back?
Yeah, exactly. Now, what about silver? What are you watching there?
Silver is in a also consolidation phase. It had a really good run up from 2009. It went from $9 to almost $50 an ounce. So it was a huge increase. So now around $30, $32 an ounce. It's a very healthy consolidation phase. It's seeing some really good support. The last week had some really bullish news, some very big inflows. Investment demand is coming back into silver. Record sales from the U.S. Treasury, Silver Eagles was, I think, a record 6+ million ounces. So I believe we're starting to kind of lift out of this consolidation period. It might also be second part of this year, but silver, I think, will be $35, $40 an ounce, and sometime this year, and then next year, or later this year, early into next year, perhaps, $48, $50 will be rechallenged, and I think after that, it's a race to $100 an ounce.
$100.
So very bullish long-term, short-term. There could be some trading opportunities. I'm an accumulator on the pullback, so anything around $30 an ounce is very attractive. especially if it goes down to the mid-20s. I don't think this market is going to stay at these levels for a very long time, so it's an opportunity to buy this consolidation.
Okay, so let's get your thoughts then on the junior miners. You do a lot of mine tours, so tell me about what you're seeing overall and maybe some of the jurisdictions that you like.
Well, the jurisdiction is a very key aspect. I focus a lot on Mexico, US, and Canada. I think those are great jurisdictions. Mexico is very mining friendly. It's one of the most mining friendly areas in the world. A very supportive government. They see the benefits of mining to the economy, to the local populations, and so on. There's a lot of great mining skilled labor down there. So I've been down there in the last several months and looked at a couple companies, Timmins Gold and Silvercrest. It was a follow-up mine tour. They've been expanding production and doing very, very well with their operations. So with companies like Timmins or Silvercrest, the miners, the junior miners producing cash flow, they're doing just fine.
You follow these ones?
Yes, I've been an investor for them for many years. Some of them are actually sponsors on this site as well, so a disclosure. But these, like Timmins Gold, I've been following since they went IPO. They acquired a past producing gold mine and brought it back into production, very successful production, 100,000 ounces a year. And those are the companies that are producing cash flows, are doing quite well. They had a really good year last year. But as a sector on the whole, it was not a very good year.
Access to equity was real difficult.
Exactly. So you have to be very selective, especially when you get into exploration. It's a very capital intensive business. There's a lot of companies to choose from. And only a select few have done well and are able to raise capital. You know, there's some stat that one that I think it was John Kaiser did show that over 50% of the companies are sitting on less than $100,000 in cash, which is not months of survival in cash.
So you see a bit of a cleaning out maybe of the sector.
It's in some ways it's a healthy consolidation. It's a much deeper one that's probably necessary. From the macro perspective on gold, it's a very positive thing because it doesn't allow development exploration work that's needed to bring on the new mine supply, which has been really stagnant over the last years. Despite the higher gold prices, now we're really seeing much of a mine expansion, gold mine supply expansion. So these exploration companies, if you find the right ones, you can do quite well. It might still be another 6-12 months before you'll see a lot of the risk capital, speculative capital come back into the sector and start lifting these prices back up. But there are some companies that are doing well, and I think sometime within this year or so, we'll start to see a really good junior exploration sector come back.
So good opportunity to buy coming up. Yes,
you have to be selective. I mean, we might see at the end of this year, a portion of these companies gone, acquired, so on. So if you are in the right companies, I think you'll do well. Some of them not so well.
And that's really the $64 million question is how do you know what are the good companies? What do you say is most important when it comes to due diligence?
Management. Management is the key. There's a lot of companies run by geologists who might be very technically qualified with the property, but to run a company, financing, raising money, and managing the company, understanding the markets, it's very difficult to find that combination. So when you find a junior which has the technical, the proper management financially, that combination I look for, and then property, share structure, and so on.
Okay, I wanted to ask you about your new website that you launched, goldreview.com. This comes on the heels, you started the first website 15 years ago or something.
Yeah, well, we started Gold Seek as a hobby back in '95, and today we're one of the top most visited gold and silver news websites. And Gold Review, we just relaunched as a gold silver news headline website. So we're quite excited to provide a new resource for the sector to keep on top of all the latest in the market.
So that's your newest venture, and what are the next plans?
Yes, well, we're working on some other plans. I can't talk about them just right now, but sometime mid-year, later this year, we have some really interesting, very exciting things we're working on.
Okay, well, that'll give us something to talk about in June then.
There you go.
Thanks, Peter.
Thank you.